Welcome back to another explainer. Today, we're diving into an absolutely wild cinematic story of cause and effect. We're going to look at how a struggling, dying textile mill morphed into a $1 trillion corporate juggernaut. This is the incredibly rich history of Berkshire Hathaway.
Right off the bat, let's start with a cold, hard fact. Warren Buffett himself actually described his purchase of Berkshire Hathaway as a monumentally stupid decision. Yeah, you heard that right. The greatest investor of our time called the very foundation of his entire empire a massive blunder.
So why would he say that? Well, he actually calculated that this one specific emotional blunder denied him compounded returns of roughly $200 billion over 45 years. If he'd just started fresh in the insurance business rather than dragging along a failing textile company entirely out of spite, he figures he'd have been hundreds of billions of dollars richer. It just goes to show you, even legends make massive mistakes. And this was undeniably his biggest.
Part 1. A monumentally stupid decision and the origins of an empire. Let's see exactly how a petty dispute over a few pennies created the Berkshire Hathaway we know today. If we trace the 19th century New England roots of the company, it reveals a pretty fascinating timeline. The Valley Falls Company was founded in 1839, Hathaway Manufacturing in 1888, and they eventually merged in 1955. Now, by the time Warren Buffett started buying cheap shares for his investment fund at just $7.50 back in 1962, the textile industry in New England was already in a massive, irreversible downturn. Plants were closing left and right, and they were laying off thousands of workers. So jump to 1964, and Buffett understandably wants out of textiles. The manager at the time, Seabury Stanton, made a verbal agreement to buy Buffett shares for $11.50 each. Seemed like a done deal, right? But a few weeks later, the official written tender offer arrived, and it undercut that handshake deal by a mere 12.5 cents per share. That tiny 12.5 cent slight made Buffett absolutely furious. So instead of just taking the hit, selling at the lower price, and walking away, he went in the exact opposite direction. He literally bought control of the entire declining textile company in 1965 just so he could fire Seabury Stanton. It was a victory of pure pride, but it left him holding the bag on a dying business. Section 2. The pivot to insurance and finding the float. Realizing that those textile mills were basically a capital trap, Buffett desperately had to find a completely new engine for growth.
And that brings us to this absolutely crucial concept of float. Float is simply the retained insurance premiums. It's the money that insurance companies collect from their customers and hold on to before they eventually have to pay out claims. Buffett realized this float could serve as a massive, virtually zero-cost source of capital for his own investments. He put this brilliant realization to work in March of 1967 by purchasing the Omaha-based National Indemnity Company for $8.6 million. This single strategic move marked Berkshire's entry into the insurance business and completely transformed its trajectory. And the crazy part? He did this long before finally shutting down the very last of the original textile operations in 1985. The success of that pivot was just staggering. Under Buffett's leadership, from 1965 all the way to 2023, Berkshire's compound annual growth rate hit 19.8%. That nearly doubles the 10.2% growth of the S&P 500 over a massive 58-year span. And even weathering the inevitable market downturns and the occasional misstep, like an infamous $400 million loss on Dexter Shoe Company, the stock only had negative performance in 11 individual years. Moving into Section 3, building a business empire through the acquisition machine. Let's look at exactly how he built out that massive portfolio using the insurance float. For an amazing example of their strategy, consider this. Back in 1972, Berkshire purchased See's Candies for $25 million. By 2019, that investment had generated over $2 billion for Berkshire. That is an astounding 8,000% return. This perfectly captures his long-term strategy of finding companies with strong competitive moats and highly predictable returns. Beyond candy, Berkshire's playbook is acquiring massive, mature companies outright. We're talking about huge names across really diverse sectors. Geico in insurance, Dairy Queen in retail, BNSF Railway in transportation, and NetJets in aviation. Buffett's hallmark is buying these companies and then granting their leadership incredible management autonomy. He lets the industry experts run the day-to-day business, while he allocates the capital.
But alongside full ownership, they also take massive non-controlling stakes in public companies. Berkshire has historically held significant shares in giants like Apple, Bank of America, and, famously, the Coca-Cola Company. They actually began buying Coke in 1988 and have held 400 million shares since 1989. It's a brilliant dual-pronged approach: own great businesses outright and buy big pieces of great public companies.
So, what is the underlying philosophy tying this massive, diversified conglomerate together? Let's get into Section 4, the Berkshire business model, value, and decentralization.
At its core, this was all driven by aggressive value investing. This philosophy of buying undervalued, understandable, mature businesses was heavily accelerated by Vice Chairman Charlie Munger when he joined the fold in 1978. Together, they purposely avoided high-tech firms they felt they didn't fully understand and instead stuck to predictable, cash-generating engines for decades, right up until Munger's passing in 2023. Now, this stat is absolutely wild to me. Despite overseeing a global empire, this radically decentralized model is managed by an unimaginably tiny headquarters staff. At the end of 2024, the corporate office in Omaha, Nebraska had only 27 employees. 27! They completely empower their subsidiary managers to run the show, keeping the corporate layer incredibly thin and remarkably efficient. Section 5. Beyond Warren Buffett and the $1 trillion future. In August 2024, Berkshire actually became the first non-technology company in the U.S. to cross a $1 trillion valuation, making the ultimate question one of legacy and succession. Ending a legendary 6-decade run, Buffett eventually handed the day-to-day executive reins over to Greg Abel on January 1, 2026. While Buffett remained in an advisory role, Abel officially took the helm of the trillion-dollar ship. And Abel quickly made his mark, proving for sure that he would maintain Berkshire's famous dual model. In June of 2026, he acquired homebuilder Taylor Morrison outright, expanding their presence in the housing market. But simultaneously, he expanded Berkshire's public market stakes in artificial intelligence by increasing their holdings in Alphabet, Google's parent company. As we wrap up this explainer, I really want to leave you with a provocative thought. With over $400 billion in cash and short-term securities sitting in their reserves today, the war chest is practically overflowing. Under this new era of Greg Abel, what massive empire-building move do you think Berkshire Hathaway will make next?